If you're a homeowner in need of cash and considering your options, you've probably come across terms like HELOC and home equity loan. But what do they actually mean, and how do you decide which one, if any, is right for you? Don't worry, we're breaking it down step by step so you can make an informed choice. Let's dive in. What are HELOCs and home equity loans? All right, let's start with the basics. Both HELOCs and home equity loans let you borrow money based on the equity you have in your home. As a reminder, your equity is the amount of your home that you own, or your home value, minus what's owed on your mortgage and any other liens. A HELOC, or home equity line of credit, works a lot like a credit card. You can borrow money as you need it up to a certain limit during a set period of time, often up to 10 years. This is referred to as the draw period. During this time, you're only paying variable interest on the amount you've drawn. Then you'll enter a repayment period, wherein you'll pay the principal plus any remaining interest. A home equity loan, on the other hand, gives you a lump sum of cash all at once. You'll pay it back in fixed monthly payments over the lifetime of the loan, which is typically 30 years. So, which one makes sense for you? Well, that depends on your situation. Do you qualify? First things first, do you meet the requirements? To qualify for either option, you'll generally need a FICO score of at least 680, a loan-to-value ratio between 80 and 85%, a debt-to-income ratio no higher than 43%. It's also worth noting that both HELOCs and home equity loans can come with prepayment penalties, and HELOCs sometimes include cancellation fees too. What's your financial need? Next, think about why you need the money. If you've got a big expense like a home renovation, a home equity loan might be the better choice. It gives you a larger lump sum, which is also great for consolidating debt into one lower interest payment. A HELOC, on the other hand, is ideal for short-term or unpredictable needs. The interest rate can vary, but it's flexible, letting you borrow as much as you need when you need it. What about interest rates and fees? Now let's talk costs. Home equity loans tend to have higher interest rates and closing fees, usually between 2 and 5% of the loan value. HELOCs often don't require closing costs, but they may come with annual fees and minimum draw requirements. Keep in mind, HELOC payments are adjustable, so you could owe more if interest rates rise. What are the risks? Here's where you need to be careful. Both HELOCs and home equity loans use your home as collateral. With a HELOC, your lender could lower your credit line or even revoke it if your home's value drops or your financial situation changes. And if you default on either type of loan, you risk foreclosure. That's why it's so important to weigh all your options before committing. If you're looking for a way to access your equity, there are other options. A home equity investment allows you to access your home's equity in cash with no monthly payments and no impact to your debt-to-income ratio. Like a home equity loan and a HELOC, your home secures the agreement. But instead of paying back principal and interest, what you owe is based on your home value and the length of time you keep the investment, among other factors. Make the right choice for your situation. At the end of the day, it's all about finding the option that works best for your financial needs and goals. Whether that's a HELOC, a home equity loan, or a home equity investment, you now have the knowledge to make an informed decision. Thanks for watching. If this video helped clear things up, give it a thumbs up and subscribe for more tips to navigate homeownership with confidence.